Hello traders, this is Lewis here with the POC Trading Camp, and today we are going to be talking about market structure. I decided to talk about market structure as the first video in a series dedicated to help anyone who wants to learn how to trade without getting distracted with all the nonsense that many videos and people out there they are trying to convey as the holy grail of trading. There is no holy grail in trading. All that really works is your own technical analysis. What fits your personality, what fits your psychology, and how you can trade that effectively is the secret to trading. Now, trading is a psychological process in which millions of people are gathering every day by the minute looking to make a buck. They are on the market to make money. You are in the market to make money. To make money in the market means that someone will have to lose. And only those who have a clear understanding of how the market moves and a solid psychology to treat the market with respect and understanding, together with a solid money management system, will guarantee you to be successful for the long run. Those are skills that you can only learn and apply in the market with consistency after several months, if not years, of trial and error. This is a market in which once you understand how it moves, it will gratify you beyond your imagination. If you decide not to learn how to trade the market as a professional, then the market will punish you and will take everything away from you. So let's get started. As you already know, I love to speak with no BS, and I love to start with naked charts and price action. If you want to measure the market structure, it's important that you get your chart naked. No indicators, no line, no trend lines, nothing. Just the candles and the on the chart. Now, you can very easily go and start looking for highs and lows and identify supports and resistance area or supply and demand areas. However, there is a better way to identify exactly the points of control where the market either goes into a range or accumulation period or reversed from a previous trend, or perhaps it continues or is about to continue on a trend direction. Now, many of you have already spent hundreds of hours researching the market, studying the market, only to come to the frustration of it's never the same to trade the markets in a consistent way when you follow indicators versus follow price action. So before we get to the price action, which is going to be on video number 2, I want to take a look at the Euro Japanese yen here. And I want to show you a small trick how to start your analysis for identify the market structure. The first thing you want to do is go to a line chart. Line chart will help you identify the actual and most exact points where resistance was found. The reason being for that is the line chart is uh, it's designed to show you the closing price. So what you see on every one of these tips are not the stand of the wick, but is actually where that candle closed or where price closed before the next candle open. Now, we like to start our analysis from a top-down perspective, so we always start from the daily. In the more advanced material that I have on the POC Trading Camp, we do analysis on the weekly and the monthly. But for most of you, starting with a daily should be more than enough to start with a solid understanding of the structure of the market. And the reason being for this, every one of these candles represents a whole entire day of trades. So when I look at a candle from opening to close, I can get a very good idea of what the market is trying to show me in regards to the type of environment that we're in. So the daily chart will allow you to get that idea on how the market is moving on any given day. Now, going back to the daily, I recommend that you open a TradingView account. Even if you trade from a MetaTrader account or a CTrader platform, it doesn't matter. I recommend to use the TradingView simply because the amount of tools and resources that you have, even on the free account, are by far one of the closest to a professional set of tools if you know how to combine them. So let's get to the point. We look at the line chart here on the TradingView chart, and you want to start after you did that. I want you to go and type on the indicators, and this is not really an indicator per se, but it helps you start understanding where you are with the market. And we're going to go with a 52-week high and low. And you can pick whichever one you want. I like to use, I guess, this one. And what this is doing is going to give you an idea of the 52 weeks high points and the 52 weeks low points. Okay. And this is important because traders all over the world, they look for these points to set limit orders, whether on the short side or on the long side, after the price hits a 52-week high or a 52 low. So knowing this, it's already giving you a huge advantage over someone who is a new trader and don't understand the 52 week or the 52 week high or 52 week low. Again, why do I like TradingView? This is a free indicator, and you can just, as you saw that in just a few clicks, and you have it already on, and it will be on all your charts, regardless of the asset that you're looking to analyze. So right now, as you can see, price touched the 52-week high, and look what happened immediately. So guys, this is why in trading, you probably heard of KISS, the KISS principle. KISS means keep it simple, stupid. Keep it simple, stupid. Keep it. So this is why trading market structure can be so profitable, even if you don't do anything else. Check this out. If you don't do anything else and you just trade 52 week highs and 52-week lows, you will be banking. Check this out right here. Let's say you just are waiting somewhere here, right? You are right here. You already know the price will reach a 52-week high here at this level, which is the 137.47. You can run that up to 137.50. Okay, so you already know that. So you'll go to your MetaTrader, your CTrader, or whichever trading platform you're using, and you set a limit order to what? To sell at 137.50. You'll probably want to set up a stop loss based on your ATR. I'm not talking about that now, but your ATR will give you average true range on every candle move. So you'll have an idea how far you should set up your stop loss just with an ATR. You can also look at previous price structured above the 52-week high. In this case, you probably can set up a line right here. And by the way, I'm gonna speed up a little bit. Feel free to pause the video, come back, and do your thing as you wish. But I can guarantee you guys, you can just do this and you will be making money. Now, if you follow my series of video, I recommend that you subscribe to my channel and just follow because I'm gonna be releasing in a series fashion, like video 1, video 2, video 3, and each one of those videos will build upon each other. But if you decide to just watch this one video and just take it for what it is, which is a solid way of trading, simple, then you can very much just apply this very small principle. Check this out. I'm moving this around because I'm trying to just show you how you can set up a limit order here on a 52-week high. And I will probably set it up a little bit higher for just in case those market makers are there trying to get you into a trap, making you close your position by stopping, by getting you out on the what we call a bull trap, thinking that it's going to break the 52-week high, and it never does, and then it comes back. So I will set up my stop loss a bit higher. I am not calculating any pips amount or how much my entry is going to be. I can tell you one thing: I only trade risking 2%. Okay, so step one on market structure. Let me put this here. Market structure. Step one, get your chart naked. Step two, main chart. Step three, 52-week high, oops, and low. And just identify the point. Okay, just identify the point, and you can very easily set a limit order right here to short the market. And if I'm shorting the market from this perspective, I'm going to go to the lowest, to the nearest strong support. In this case, I'm shorting, so I'll look to the nearest strong support, which it will be somewhere right here around 13200. Let me just put it right there. If I want to be very precise, I can just type it in into the psychological number, but I think this is good right there. Okay, because typically, or not always, but sometimes price does push through a little bit, like you can see here, and again, it just bounced back up. But I will set up my trade this way. Now, look what happened. If you're looking at this lane chart right here, at 136.30.83, it's 90. You know it's about to hit the 52-week high. Then you already saw the future, but look what happened. Look at this, guys. So, and don't feel bad, okay, because look how it respected the support. Right here, it respected the support and it bounced back. So if you set up your trigger to limit order on the short side to enter here, and you drop all the way down here, look what happened. Look at the good news. Now, this is a daily chart, so it will take probably a week or two to reach your level. But look how easy, guys. 565 pips in 7 bars or 9 days. Okay? So that's a week and a half. A week and a half. One trade, 565 pips. Tell me what's more profitable. You taking all the indicators in the world, filling your charts with so much color, so much noise that it's just hard to predict, and all these trend lines, when all you really needed was a 52-week high and 52-week low. And when you understand market structure, you know that's support and resistance. You want to look for this type of support. Look how many times this thing bounced. Now, and in the next video, we're going to talk more in detail about support and resistance, supply and demand. But you know, the best time to enter or to trade a support or resistance, or in this case, a 52-week high, is the first, second, and maybe third time it touches it. Because after that, if it keeps touching that support or resistance continuously, like it did here, you know that there are sellers in this case pushing and trying to violate this level, but they couldn't, so they gave up, and then you know it just went all the way up, and you enter this beautiful trade with confidence. It never went into your stop loss area, and you never even risked. If you went in here, guys, this is a solid, almost non-existent drawback. Okay, it's the first touch of the 52-week high in a long time. I'm talking about how long it is. It was right here, I guess, the last time that it came close. Check this out, guys. This is September, date is right here. This was September of 2015. And the price came back to that level on 2018. So was this a significant area? Absolutely. Did it touch how many times? Only one, and immediately dropped down. Just to give you understanding why these type of things happen, guys. Professional traders, institutional traders, hedge funds, and even commercial traders, they place their limit orders in these levels. That is just simple. And when you have a huge number of orders in a particular area, when price hit that area, it triggers all those orders and it causes price to react. And all you got to do is be an observant. You got to be looking. The market is composed of retail traders and institutional commercial traders. The retail traders, they follow or what's happening with the institutional and commercial traders. The experienced traders, they don't necessarily follow, but they wait. They look, they observe what is the market maker doing. What are they doing and what are they going to do based on past performance? And you try to, in a probability fashion, you try to anticipate that move instead of following, because following is what gets people stopped out and lose money. Okay, so anyways, I want to make this video real quick, so I'm about to finish. Price hit right here, the 52-week high, and then immediately it dropped. You would have made 500 pips on this drop alone. Remember, risk reward ratio is important, and with that, money management is important. So your stop loss needs to be not on a pip amount. Like I hear new people always asking, how many pips should I put my stop loss? That is ridiculous. Do not put stop loss based on pips. You only do stop loss based on technical structure, okay? If you cannot afford the stop loss, if right here, if from here to here, I'll tell you this right now, look at this. If you cannot afford a stop loss of 113 pips, okay, then you need to adjust your lot size so that you can adjust. If you cannot afford 113 pips, $1 a pick, that's $113 you're risking. But you made 565, so 558. So if you cannot, look at the ratio here, $113, $1 per pip you were risking to make 558. It's worth it, absolutely, all day long. But if you cannot afford 113 because your account is too small, then you gotta trade then micro lots and trade it in pennies. But your stop loss cannot be based on pips. It gotta be based on structure. So we set it up right here because we knew the chances of market to not go any higher than that, we set it up right here. This is what we used. And could have been all the way over here, and that's why we set it up kind of on that direction. And perhaps I should have been a little bit higher, but hey, I'm just doing an example just to give you and show you the principle. Okay, so you could have risked $113, $150, yet you would have made in a week and a half $568. Now, if you can stand standard lots and you do $10 per pips, then this 565.58 pips would have given you a outstanding amount of $5,000. Yet you were risking 1,000 and change. So it's all relative, guys. Okay, it is all relative. So you only set up your stop loss based on how much you can afford. All right, so guys, I really want to keep it simple. I can add some more stuff, but I don't want to get you tired with so much information in one video. I'm going to leave it as is for now on video one. Right now, let's just focus on identifying the 52 weeks highs. You can just simply, guys, check this out. Once you set this up, just go on every pair. Look at this one. This is the Australian dollar, Japanese yen, 52-week high. Born all the way here. I mean, just calculate the drop. First touch after a while. This is the first touch in 2017 since 2015. Has it reached the 52-week high again? No. It's going towards. It's actually already hit. If I can draw right here, it already hit the demand zone. How do I know it's a demand zone? Check this out real quick, and I'm gonna leave this one for the next time. I actually use a very nice technique using Fibonacci retracement, a particular one that I set up for me. But I can just highlight right here, boom, this level. I can show you how to draw this level for, let me get this Fibonacci out of here. Okay, look at this. If I go real quick, I know this is demand area, because the price did not close in the touch of the 52-week low, but it closed in this demand area. If I go to my chart, look at that. Look at that. And I'm going to talk about supply and demand more in detail next time. So check this out. This is all demand. Okay, when you are on the bottom of your support, or in the bottom where the support is, that's considered demand. When you are in the top where the resistance is, that's considered supply, which it will be right in this whole section. Okay, but it did touch. So let me ask you something. It touched the 52-week low. It reacted. We put out our lane chart. Where do you think the price is going? Well, you already kind of late for this type of trade looking at a touch of the 52-week low, because you are experiencing a touch at a resistance right here. So we need to watch what the price is going to do, whether it's going to violate that resistance and continue to go up, or it's going to just simply drop. Let me erase this. This was from a previous past analysis I was doing. Let me just drop this down here. So you gotta watch price action. I would not enter just because on a long side, because it might just bounce back down and retouch the 52-week low, and then at that point might be an entry. Or if it violates this area, then just look for a violation, comes back, bounce, and then you go long. Okay, but 52-week lane chart, guys. 52-week. Look at this one. Look at this one, guys. Check it out. 52-week low. Look at this. Please keep it simple, guys. The reason why there are so many indicators and all these BS out there is simply because they want you to lose money. Okay? It's just that simple. 193 pips. This was a longer rally. This is the Australian dollar, and then New Zealand, the Aussie. So it does take some more time to move. The European yen, as I showed you earlier, the Euro yen is a much faster pair. Everybody knows that. This one takes a little longer, but yet again, you could have set your entry long position at the 52-week on the demand zone, and you rally this thing up all the way until it hit this level. If I was doing this trade, I would have done it until I hit. Probably I would have done it until I hit this level right here. I am happy with small pips as long as it gives me profit. I'd rather have a strategy that gives me 90% win ratio than a strategy that give me 30% risk ratio because I'm greedy. I'd rather win 141 pips. To be honest, I'd rather win 100 pips. Okay, and just be happy because here was a very, well, not a very, but it was a significant area of resistance. So I probably would have just even get out here. I don't know because it could have bounced and lose my profit. But this is how point of control. This is only the beginning, guys. This is the most simplistic way to trade that works all the time, every time. And if you have this, check this out, guy. Again, please. And I'm giving you this for free. For free. There is no mysticism. There is no magic. It's simple. Just trust your instincts. Trust your analysis. Okay, this is right here. Look at this. This is the main area. Look at the wick. I bet the wick. Check it out. I laugh, guys, because I'm giving you pure gold. POC Trading Camp. We're not here to BS people. We're here to help. I really want to help as many people as I can to be successful. Who traced this line? I didn't. I just put the indicator, 52-week low, 52-week high. If you are coming down here, look at the strength of the sellers, only to come to this indecision on this day, and then the next day, it was like if it was traced, with a ruler, boom, and it rallied back up. Just this trade alone, you would have set your entry. I probably would have set on the whole number of 7180. Okay, I like to trade psychological numbers, so I probably would have entered here, and from here to here. 2 days, guys, 2 days, 101 pips. Tell me of a strategy that is as simple as this, can give you 100 pips. So guys, trust your strategy. Have a good day. I love you all. Join the trading camp on my Facebook page. I send all kinds of setups on a weekly basis there. Subscribe to this YouTube channel because I am going to be releasing about 7 to 8 videos that are going to be building upon each other. And they're all going to be like this. Simple stuff, practical stuff, no BS. It's just getting ready for you to trade right away, whether you are a beginner or you are a struggling one who has been trying to be profitable and seems to find a way to always lose money. My trading style, the point of control, the POC system of the trading camp strategy works. I've been trading for 12 years and I can tell you it works. Have a good day, guys, and have a happy trading week.